Hello and welcome to another video on IND AS. So today we are here to present about IND AS 19 employee benefits. So we'll quickly have a look at the agenda and then we can move forward. So what we're going to cover today is objective and scope, the classification of employee benefits, short-term employee benefit accounting, defined contribution plans, defined benefit plans. Then we'll also have a look at defined benefit plans measurement, remeasurement through OCI treatment and recycling, other long-term employee benefits, termination benefit, what is the definition of curtailments and settlements, presentation in financial statements, and finally the disclosure in the financial statements. And then we'll quickly touch base upon the comparison between the IND AS 19 versus the IAS 19. So this is all that we're going to cover as a part of this presentation. So moving to the first slide then. Okay, so we'll quickly touch base the scope of IND AS 19. So objective of this standard is to prescribe the accounting and disclosure for the employee benefit. Uh, we require to recognize the liability when an employee has provided the services in exchange for the employee benefit to be paid in the future, and we have to recognize an expense when the entity consumes the economic benefit arising from the services. So it's simple as that whenever we are consuming some or taking services from the employees, that needs to be recognized an expense, and then we have to recognize the liability because we are obliged to pay to the employees for the services that they have provided, and hence we have to record that as a liability. Scope: all employees benefit except all employees employee benefit except the share-based payment, which will be specifically covered in IND AS 102. And then if we try to compare it with IND AS with the international accounting standard, so it's equivalent to IAS 90. So we'll move to the next slide. Okay, so we'll quickly have a look at what is being classified as employee benefits. So if we go by the definition, so employee benefits are the all form of the consideration given by an entity in exchange for the services rendered by the employees. Very simple definition, which means any payment which is being made to the employees for the consideration in terms of when they have provided the services, any consideration which is paid to employee is treated as employee benefit. Short-term employee benefits are the employee benefits other than the termination benefit that are due to be settled within 12 months after the end of the period in which the employee rendered the services. So which means that any obligation that has to be settled within 12 months from the date when the employee has provided the services is treated as short-term employee benefit. Example, monthly salary, annual bonus payable next month. Post-employment benefits are the employee benefits which are payable after the completion of the employment, that is largely the gratuity if it all is there, or payment of provident fund if it is there. So this is being paid once the employee retires from the organization, or employees when they have completed their terms of the employment with the company. Other long-term employee benefits are the employee benefits other than the post-employment benefits that are not due to be settled within 12 months after the end of the period in which employee rendered the services. So which means that any benefit which is not treated as a short-term benefit, or any benefit which is not treated as the post-employment benefit, can be treated as the long-term benefit, because these are the benefits which can be paid, which has to be paid, or let's say which will be paid post the period of 12 months from the date on which the employee has rendered these services. Termination benefits are the employee benefit paid as a result of an entity's decision to terminate the employee before the normal retirement, or an employee decision to accept a voluntary redundancy. So any benefit which is paid to the employee, either either the organization wants that employee to get terminated because of some exigencies or certain consideration, or employee himself has taken a decision to do the voluntary retirement. So these are the payments which is being due to be made to the employee as a termination benefit. So vested employee benefits are the employee benefit that are not conditional on the basis of employment. So which means that that will be paid to the employee irrespective of the fact whether he is employed or not. And when we try to compare it with equivalent standard, it is equivalent to IAS 19. So we'll move to the next slide. Okay. So short-term employee benefit accounting. So when an employee has rendered these services to an entity during an accounting period, the entity should recognize the undiscounted amount of the short-term employee benefit. So which means when we are talking about any payment which we have to make to which organization has to make to the employees within a period of 12 months from the date when he rendered the services is treated as the short-term employee benefit. And how it has to be accounted for? It has to be accounted for as a liability as an accrued expense after deducting any amount of the already paid. If the amount already paid exceeds the undiscounted amount of the benefit, the entity shall recognize that. So which means that there is no discounting involved. This is most important. Which means that we have to pay the amount within a span of 12 months from the date on which it has been accrued, and it has to be undiscounted. It has to be accounted as an expense unless other standard requires permits the inclusion of the benefit. So sometimes the employees' costs are charged to the asset or the inventory when we are producing that inventory or when we are producing that asset. So if those conditions are not there, and then it is purely an expense which is being charged to my P&L. Short-term compensated absence are the employee leave benefits. So basically, whenever employees are taking the leaves, those needs to be compensated, are expected to be settled wholly within the 12 month after the end of the reporting period and arises from the employee services rendered to it. So which means that any leave which is being taken by the employee or any benefit which is being given to the employee on account of those leaves, that will be accounted as a short term compensation leaves if it has been taken by that particular person or that particular employee within the 12 month after date of the report, within 12 months. So example include paid sick leaves, paid casual leaves, paid earned leaves. So all these, if it is within 12 months, definitely will be treated as the short-term employee benefit and will be accounted as a short-term benefit accounting. We'll quickly move to the next slide and see the more detailed information on the compensation which is being paid on account of the absence. So let's just move to the next slide then. Okay, so let's just spend some time to understand the concept of short-term employee benefit in detail with respect to the leaves. So what we have done, we have come up with three examples and we have tried to give scenarios wherein how the accounting for leaves happen, both when the leaves are vested and if the leaves are not vested. So let's just quickly look at the example, and first we'll quickly have a look at the definition of accumulating and non-accumulating leaves. So accumulating leaves are leaves that can be carried forward to the future period. Now this has to be understood in bit detail. So when we talk about leaves that can be carried to the future period, these can be both the scenarios. Basically, it will lead to the short-term employee benefit accounting if the carry forward is allowed within a span of 12 months. After 12 months of the reporting period, it ideally becomes a long term and it requires the actuarial valuation. But if the policy of the company is that post the reporting period, you have to your maximum carry forward for 12 months, then in that case, it is treated as a short term employee benefit on which no actuarial is required. So examples, earned leave and vacation leave. So typically company after the year end, after the year in which it was not availed, it will be encashed in the next period after the reporting period. It is normally encashed or they people are getting the payment for the amount that they have not been availed during the particular accounting year. So which means unused earned leaves can be encashed in the future period. But if earned leaves are carried forward and carried forward period is more than 12 months, then it requires the actuarial valuation and it is treated as a long-term employee benefit. So some leaves are non-accumulating leaves that lapses if not used. If they are not used, there is no liability required for those leaves. It can be only be taken. The accounting only happens when the actual leaves has been availed by the employee. So accumulative plus vesting leaves are most common type. Vesting is equal to the employee will receive the payment for unused leave. Example, earned leave encashment. Recognize the liability for the unused leave. The liability is equal to expected cost of the unused leave that an employee has earned at the reporting date. So example, if you can see here, accumulating vesting leave liability requires employee earn 1 day leave per month and 12 days leave in a year. Leave is a vesting, which means a cashable. At the year end, employee has 200 unused leaves. So this is the total leaves for the total employees, and the average daily salary is let's say 200, 2000. Then the total liability that needs to be recognized is 4 lakh. Another example, accumulating leave but non-vesting leaves. So which means that employee cannot encash the unused leave but may carry it forward. It can be carried forward, but there is no encashment. Still recognize the liability because employee can use it in the next year. Because if it is carry forward is there and if it is carry forward to the extent of next year, then we have to recognize the liability. Accumulating the non-vesting sick leaves that can be carried forward but not in cash. At the year end, employee has 300 unutilized sick leaves. Only 30% are expected to be used in the next year daily, since to 2000 is the amount. So we'll recognize the liability to the extent of 1,80,000, and balance, which is going to recognize for future period, that needs some actuarial valuation and will be treated as the long-term employee benefit. There are certain leaves which are non-accumulative, non-accumulating leaves. If leaves expire at the end of the year, use it or lose it. Recognized cost only when leaves are taken, no year-end liability. So, which means that we need not to recognize any liability. It will only be expensed off in the year in which it has been taken. So, example is here wherein a person has employee has not taken the leave, and employee took 500 days of the total leaves, which cannot be accumulated. So, we have to expense it off by creating the expense, debiting the expense, and crediting the salary payable. So in the case of the short-term employee benefit, the fundamental rule is that the liability should arise in immediately next 12 month post the reporting date. Then we have to recognize as a normal current liability. But if it is beyond 12 month, then it has to be recognized in other long-term liability. And in that case, it requires the actuarial valuation because it has a discounting factor, and there is some proportion of the increment also that has happened, that has been given by the organization normal course of business. So this is how accounting happened for the short-term employee benefit. So we'll move to the next slide then. Okay. So another example for short-term employee payment is the profit sharing and bonus plan. So this is typically a scenario when employee is being given a particular share in the profits, and it has to be recognized as a short-term liability only when the entity has the present obligation or constructive obligation to make such payment as a result of the past event, and a reliable estimate of obligation can be made. So which means that if the entity has freezed the amount that needs to be paid to the employee basis the proportion, basis the rule or the logic basis which it was agreed to be paid, if that is being crystallized, if that has been achieved, then it is an obligation on the organization to create that liability. Present obligation exists. So basically what conditions are: present obligation exists when and only when the entity has no realistic alternative to make the but to make the payments, which means that payment has to be made because the condition basis which the payment was agreed has been met, and the payment is now needs to be made to those employees. Under some profit sharing plans, employees receive the share of the profit only when if they remain with the entity for a specified period. Such plans create the constructive obligation as employees render the services that increases the amount to be paid if they remain in the service until the end of the specified period. So in which case, if that particular employee remain with the entity for that specific period, then obligation will arise, and then it has to be accounted. This is that period for which he is entitled to that amount which he is being agreed upon, and if he has served that period, then he is entitled to that particular amount, and accordingly a liability has to be created for that particular amount. An entity can make a reliable estimate of his legal and constructive obligation under the profit sharing or bonus plan when and only when at the formal term of the plan contains the formula to determine the amount. The entity determines the amount and the amount to be paid before the financial statements are closed. And the past practice gives a clear evidence of the amount of the entity's constructive benefits. So if these conditions are met, then it has to be treated as a short-term liability, and it has to be accounted for as a short-term liability, and we have to create a provision which means that it needs to be payable to the employee, and it would be treated as the short-term liability depending upon completing all the condition on which the obligation arises. So we'll move to the next slide then. Okay, so now we'll speak about the defined contribution plan. Okay, what does defined contribution plan means? So post-employment benefits plans are classified as either the defined contribution plan or defined benefit plan. So there are two plans: defined contribution and defined benefit. So in this slide, we are going to speak about defined contribution plan. Depending upon the economic substance of the plan as derived from its principal terms and conditions under the definition, contribution plans are what? Entity's legal or constructive obligation is limited to the amount that it agrees to contribute to a fund. So which means that in a typical scenario, when we are talking about the provident fund, then the obligation of the organization is to contribute the amount which is equal to 10% or 12% of the basic salary. Beyond that, entity is not obliged to pay that amount, irrespective of the fact whether the discounting is there, whether inflation is there or not there. It is irrespective. So entity's obligation is restricted to the amount which has been agreed by the statute, so which is like 12% if you're talking about the provident fund as an example. Thus, the amount of the post-employment benefit received by the employees determine the amount of contribution paid by an entity to a post-employment benefit plan or to an insurance company, together with the investments return arising from the contribution. And in consequences of actuarial risk and the investment risk will be insufficient to meet the benefit, it falls on the employee. So which means that if at all it happens that there are some risk in terms of the investment which is not being done, or that was not being done properly, specifically when talking about the PF trust. So that is something that needs to be followed on the employee. I mean, any shortfall or any gain in the investments, if that is specific to the provident fund trust. But typically what happens, that's a fixed amount that is being contributed, and employee also has to contribute to the fixed amount which is then being deposited to the provident fund organization. Now if provident fund organization is, let's say, committing a particular percentage of rate of interest which is 8%, let's say they have announced 8% but they have not paid, then it is not the obligation of the entity to compensate that interest amount if it is not being paid, or if it is not been if it has been short paid by the provident fund organization to the employee. So typical example, let's say a rate was 8% in some year which is being announced by the EPFO, but let's say if that rate fall to 7.5% at some year, then it is not the obligation of the employer to pay that 0.5%. So this is a defined contribution plan in which employee is only responsible to pay a particular fixed amount to the particular fund that has been organized. So accounting is that recognize the contribution as an expense when the employee renders the service, liability for the unpaid contribution. Simple. So debit employee benefit expense and credit the provident fund payable. This is simple. Now we'll go to the next slide, which talks about the defined benefit plan. In defined benefit plan, the things change a little bit. So we'll move to the next slide. Okay. So now we'll talk about the defined benefit plan. So when we're talking about defined benefit plan, so it is the entity's obligation to provide the agreed amount to the current and the formal employees. So typical example is, so we'll take a typical example of gratuity. So which means that it has to be provided to the formal employee as well when that employee or let's say when we're talking about some sort of the benefit which needs to be paid as an obligation by the entity even after the employee leaves the company. So we'll take an example of gratuity for the simplification purpose. So actuarial risk, that benefit will cost more than expected, and the investment risk fall in the substance on the entity, because this is a fund that is being created. So there's a difference between the defined benefit plan and defined contribution plan. In the defined contribution plan, the actuarial risk, investment risk falls upon the employee, because employer is only entitled to pay an amount which is being fixed in a particular contributory fund. But in the case of the defined benefit plan, because employer has to pay a certain amount basis the actual valuation to a particular fund, and basis that it has to be valued at each accounting year. So any increase or decrease, if there is any contribution, that needs to be compensated by employer, because employee is entitled to a particular amount that is based upon the rule for that particular amount that needs to be paid. For typical example, if gratuity is there, then employee is entitled to gratuity on basis of the rule. Now to make sure that the amount that needs to be paid to that employee or set of the employees, or the all the liability that needs to be accrued, that needs to be accounted for, so that that liability, when it needs to be paid, it can be paid, and if there any shortfall in the liability, that needs to be compensated by the employer. So component of DB cost is the service cost. This is the most important, which is the current and the past service cost. Service cost represents the increase in the present value of the defined benefit obligation resulting from the employee service in the current or the past period. So typically an amount that needs to be paid every year to certain fund, which is normally called as the uh, defined benefit obligation. So right, the any amount that needs to be contributed to that fund, that is the service cost for that particular year. Net interest or the net benefit plan is the liability asset, P&L normally accounts. So basically, net interest is the amount which needs to be paid as on the liability, and it is being adjusted with the interest that has been earned on the planned asset. So what is planned asset? We'll talk very soon in this slide only. Remeasurement is the actuarial gain or loss which is normally being treated in the OCI. So any remeasurement, which means any increase or decrease in the interest earned on the fair value of the asset, not fair value, I would say, the any increase or decrease in the actual interest that was agreed to be earned on the planned asset. So any increase or decrease in that amount will be treated through OCI, because any gain is charged to my OCI, because that is not a normal operational gain. So defined plan measurement is that present value of the defined future obligation, fair value of the planned asset deducted to get the net liability and asset, net defined benefit liability and asset is equal to present value of the defined benefit obligation, fair value of the planned asset, and then the amount recognized as a defined liability shall be net of the following. So AS19 is a typical scenario wherein we have to showcase the net liability on account of the defined benefit obligation. Either we can have the net liability or net asset, because see, what is the modus operandi when we are creating the defined benefit plan? When we are creating the defined benefit plan, we are creating a corpus by investing in some planned asset, so that at the end of the year, whenever we have that liability, that can be liquidate that can be easily paid off by liquidating those assets. So basically we need to create a liability to make sure that we have the amount. At the same time, the contribution which employer makes in a particular planned asset, that needs to be done in a particular asset, so that it will yield the interest income, so that the amount that needs to be paid at the time of the liability maturation, that can be easily managed. So we have an asset value and then we have a liability. So at the end of the each accounting year, we need to figure out whether we have a obligation, whether our liability to settle the amount is more, or whether the net assets that we have is more. If we have the more than net assets, then we have to show it as a net asset, and then there is a ceiling that is attached to it. We'll talk about that in the next slide. And if it is net liability, we have to show it as a net liability. So this is how the uh, defined benefit plan is being treated. Now we'll go to the next slide and see some more detail on this defined benefit plan. Okay, so let's just spend some time in understanding the measurement of defined benefit plan. So a defined benefit plan measurement, if the value of the planned asset is more than the defined benefit obligation, the negative amount will be recognized as the net benefit asset subject to the ceiling. So which means that there can be, so as I mentioned in the last slide, so there are two scenarios, that our obligation that we need to pay, and there is a similar asset. So we have a liability that we need to pay, and then to pay off that liability, we are creating an asset. Now, at the end of each accounting period, right, we need to compare whether our assets is more or liability is more. If our liability is more, then in that case, we have to show the net liability on account of the defined benefit plan in our balance sheet, and it will be shown as a non-current liability. But if my asset increases and my liability decreases, so in that case, what we have to do, we have to show it as a net assets, right? But as per the IND AS 19, there is a ceiling that is attached. And what is that ceiling? It says that in case your net planned assets is more, planned asset is more than your uh, defined benefit obligation, then the difference can be shown subject to two things. If let's say in the future period, you are going to get some refund from that particular planned asset consortium, or there is some waive off that is going to happen in terms of a future liability, right? So the waiver of your future liability plus refund, that if added, that is the total amount of the ceiling that needs to be attached. So we are quickly demonstrating it with the help of an example here. So what we are saying here, that defined benefit obligation is 90,000, fair value of the planned asset is 1,20,000, so we have a surplus 30,000. Okay, so which means that economic benefit, now they are saying that there's economic benefit. We have a 5,000 refund that is going to get, and we have a contribution of 5,000 reductions of waiver. So total benefit that is going to realize is 10,000 economic benefit. So which means that though we have a gain of 30,000, but recognition is only happened to the extent of 10,000 through the OCI, and not allowed to recognize full, which is 30,000 surplus. So which means 30,000 will not be recognized. Only 10,000 will be recognized as a profit, and then this 10,000 will be shown as my net assets in the balance sheet. So simple rule is here: if my present asset is less than the DBO, then it is net liability, normal defined benefit. If my PA is more than DBO, it is net asset, allowed only if recoverable, and asset ceiling applies. Net assets are limited, excess not recognized. As simple. So we have to recognize the net asset subject to the ceiling, and that ceiling depend upon the amount of the refund or the amount of the reduction in or waiver in the contribution that is being availed in that particular period. So our total surplus will be subjected to that increase only. That will be only the portion that will be recognized by debiting our net assets and by crediting the OCI. So we'll quickly have a look at the detailed example to understand the concept in complete detail and with complete clarity. So we'll move to the next slide. Okay, so this is a detailed example, and we'll go very slow because this example that will help you to understand the concept in absolutely detailed. So what we are saying, total salary all employees in the year one is 6 lakh rupees. Salary growth 5% per annum in year two, 6 lakh 30,000 rupees. Employees are expected to stay 15 years, so the accrual basis is 115 salary per year. Benefit formula is used, so we are assuming that because it is 15 years, so we are just assuming that there is actuarial valuation that the my contribution in the first year would be 40,000 rupees, which is nothing but 6 lakh divided by 50. So that's an actuarial estimation of the uh, uh, defined benefit obligation. Discounting rate is 7%, typically market assumption. Expected actual return on the planned assets. So we are taking two scenario. At first year we are saying 8%, and second year we are saying 5%. So this is a typical example. Had this been defined contribution plan, then the obligation is not upon the employer, whether the rate is 8%, 5%, or any percent. But in this case, if let's say my obligation reduces, then if my the liability amount falls short of the total planned asset, then it is the liability of the employer to compensate that. So we'll look at that. So because this is the first year, there is no opening defined benefit obligation and there is no planned asset. But assumption is that employer contribution timing, the contribution is made at the start of the each year, so that we can have the planned asset. We can earn the interest on the planned asset for the first year. So no benefit is paid, no actual experience, gain or loss on the investment, no asset ceiling assumed. So we are assuming there is no asset ceiling, so which means that if at all we have a situation wherein our net asset, our planned asset is more than our defined benefit obligation, then the entire amount will be shown as a net asset. So we have shown this in the year on year basis. So what we are saying, first is the calculation of the service cost. So there are three components we mentioned in the earlier slide: the service cost, right? Second is the net interest, and third is the actuarial gain or loss that will be treated through my OCI. So first year we are saying that total service cost, which is the amount that will be contributed to purchase my planned asset. This is a liability, that is a defined benefit obligation. So my service cost is 40,000. Employers start contributing in the start of the year. So assuming that entire 40,000 would be invested in the planned assets. So amount invested in the planned assets is 40,000. Now if we correspondingly look at the entries here. So in first year, we have debited the P&L with 40,000, which is the service cost, and credited the defined benefit obligation to 40,000. And at the same time, we have also created an entry to purchase an asset, 40,000, and we have credited a bank. So which means that we have created a liability, and at the same time, we have purchased an asset. Now, actual interest earned at the end of the year one on the planned interest is 3,200. So this 3,200 is the total interest that has been earned. So very been it is going to increase my planned asset to the extent of 3,200. However, there are two entries which we are shown as profit and loss and OCI. So we'll look at these entries in this particular section of the presentation. So what we are saying. So simple concept is that we have to create the amount, we have to calculate the net interest. So net interest is nothing but the amount that is going to be contributed in my DBO versus the amount that has been invested in the planned assets. So in this case, my DBO is zero because I do not have any opening obligation, right? But my investment in fixed asset is 40,000. So which means my 7% of 0 minus 40,000 is minus 2,800. So our discount rate, which is like 7% on my obligation. My obligation was 40,000. So on 40,000, I have to discount it off because I have to make sure that I have to pay this liability in next 15 years. So my discounting will happen on this 40,000 because it has a present value associated to it. So we have to inflate it to make sure that the amount that we need to pay at the end of the 15 years, that should be get compensated. So there's a finance cost that is attached to it, which is like to the extent of 2800. So remeasurement gain will happen, which is nothing but the remeasurement gain is actual return minus the discounted rate into the opening PA. So my actual return is 3200 because this is the interest that is being earned on my planned asset, right? And then my discounted rate is 7%, which is the discounted rate that we already shown into the opening PA. The opening PA was 40,000. So 40,000 multiplied by the discounted rate is equal to 2800. My total interest earned is 3200. So remeasurement will happen, and this 400 will now will go to my OCI. So you can see here the entire 3200, which is the planned asset, the two component of the interest is broken into. First, the amount which is being charged to my PNL, which is credited to my PNL in this case, because I do not have any finance cost in the year one, because my obligation was created at the year end. So there was no DBO at the opening of the year, and the rest will go to my OCI, right? So my planned asset is what? My planned asset is 40,000, which was starting of the year. It will be increased by 3,200. So my planned asset at the end of the year one will become 43,200, and my deferred and my defined benefit obligation, it was 0 at the start of year, and at the end of the year has become 40,000. This is clear. Now we'll go to the next year. And the next year, what is happening, that we again have to calculate the service cost. Now we are saying that there's a salary growth of 5%. So which means that our contribution will increase by 5% on 40,000. So our service cost will become 42,000, and the amount will again be utilized and invested in my planned asset. So 42,000 investment planned. So you can see the entry here. We have created the service cost by debiting the P&L, crediting the defined benefit obligation, and then we have created a planned asset here. Again, we have purchased the planned asset by 42,000. Okay. Now what's happening? Our opening DPO was 40,000. Our closing DPO was 40,000. So opening billing was 40,000. So interest on the opening DBO is 2,800. So this is my finance cost. This is my finance cost, because this is the amount that we have to create as a present to make sure that we have the present value obligation. So it's basically inflating the basic amount to get the equivalent present value basis the discounting rate. So we are discounting rate of 7%. So this is the entry. You can see we have this is a charge to my PNL, which is my PNL to the defined benefit obligation. So my benefit by obligation will be increased by 7%. My opening planned asset was 43,200, as you can see here. This is the opening planned asset. The actual interest on the PA in the second year is 5%. So we have mentioned 5% here. So on my 43,200, I'm earning the interest of 4260 when I applied the rate of 5%. However, my 7% interest will again be applied on my opening DBO. My opening DBO, which was 0 in the last year, and hence there was no discounted apply. But in this case, when I'm in second year, the interest would be applied on my opening DBO, which is 7% on 40,000, which is like 2,800. So which we have shown here. Now what will happen? We have to apply the discount rate. So the same formula we have to employ. We have to apply the discount rate on the total planned assets. So we'll apply 43,200 on 40,200. We'll apply the rate of 7%. That is equal to 3,024. When we compare this 3,024 with the 2,800, right? So we have a negative impact. So which means that our interest is earned is more than the discount that has been offered on my deferred defined benefit obligation. Okay, so this is the amount that will be shown as my credit to my PNL. So what will happen? So my planned asset is the total interest earned is 4260. My profit and loss account is 3024, which is nothing but this amount, and my PNL charge is 2,800. So if you subtract 3,024 credit with 2,800, it will equal to my 224, which is nothing the credit to my PNL. So as I mentioned that this is the difference that will be credit to my PNL. The total interest will be credited 3,024. Out of that, the PNL will be charged with 2,800. This is because on account of my DBO. Then the net benefit to my PNL will be 224. There's another element of remeasurement that will happen, and what will that be? See, remeasurement will happen on the two things. the total interest earned, which is like 4260, minus the amount that has been adjusted by applying the rate of 7%, which is like discount rate. So total interest earned minus the discounting rate is the amount that is will be transferred to my OCI. This is the amount that will be transferred to my OCI, because this is the gain over and above the amount that is being used as a 7% factor. So basically, interest earned over and above the discounting rate is equal to the amount that will be charged to my OCI. So if you look at the total planned asset in this case, so my planned assets was 43,200 at the beginning of year, right? And then we have earned the interest of 4260. So when this is added to my 4320, my closing planned asset will become 89460. By defined benefit obligation, which was 40,000 in the start of the year, right? So what has happened? My obligation will be increased by 2800, which is nothing this, plus it will be increased by 2000 here. So my 42,000 plus 40,000, which is 84,000, and then 2800 would be added from PNL. So that will be my 84,800. So this is the PNL. This is the total defined benefit obligation. Now we'll quickly go to the next slide and see the presentation of this in the financial statements. Okay. So now we are quickly going to show the presentation in the financial statements. So what we are saying here is that in the first year, my total service cost was 40,000, second year 48,200. Net interest in the DBO was minus 2,800, that we have shown in the last slide, and net DBO in my is minus 224. So my profit and loss is 37,200 at the end of the first year and 41776 in the second year. OCI measurement 400 in the first year, second year 1236. And in my DBO balance sheet, we have a DBO of 40,000 in the first year, 84,800 in the second year, planned asset 43,000 first year, 89,460 in the second year. In both the cases, my planned asset is more than my DBO, and hence we have a net defined benefit asset, assuming no ceiling, of 3,200 in the first year and 8,460 in the second year. So this is like a bit complex example, but this is how it is being represented and shown in the financial statements. So we'll move to the next slide. So just quickly reiterate the three component of defined benefit plan. So what we are saying here, my defined benefit plan has three component. First is service cost, net interest cost, and third one is OCI includes only. Now we'll quickly go look at each one of them separately. So my service cost is the current service cost plus past service cost plus any curtailment and settlement. We'll speak about this in the next slide. Net interest cost is the opening DPO minus opening planned asset into the discount rate. So we use this formula in the last slide. This is not the finance cost on the DBO loan. It is the net interest on the net liability or the net assets. Likewise, remeasurement is actual gain or losses on the DBO, difference between the actual return on the planned asset and the expected return, and the impact of the change in the assumption. So these three we also looked at, that we applied this difference of the rate of 7% versus 8% on the planned asset to identify the amount that will go to the OCI. And then the balance sheet recognize the net defined liability simply. In case of the asset, we have to recognize it in an asset, but if there is ceiling, it has to be restricted to that ceiling. And we also spoke about that ceiling in one of the example, wherein we show that we have the obligation of 70,000, we have an asset of 1 lakh, we have the total benefit of 30,000 as a surplus, but still it was restricted to 10,000 because the refund plus the waiver in the contribution was to the extent of 10,000, and hence we restricted the surplus to only 10,000. So we'll move to the next slide then. Okay, so we talked about the other long-term employment benefit. So basically, any benefit which is not short-term is stated as a long-term, and then it has to be shown as per the actuarial methodology, and then we have to make sure that any kind of gain or loss on the actuarial valuation will be passed to my OCI. We also have the termination benefit. So termination benefits are largely on account of when the organization terminate an employee on account of some restructuring or redundancy, or in any case when employee himself takes the voluntary retirement. So whatever the case may be, we have to recognize the liability and expense when the entity is demonstrably committed to the termination. So in simple entries, like we have to debit the expenses and charge to PNL and credit the liability for that particular case. We'll move to the next slide then. Okay, so we'll spend some time in understanding the concept of curtailment and settlement. So, curtailment means occurs when an employer significantly reduce or further future services provide period over which employees earn benefit. It results in the material reduction of future obligation. So, basically, it's a situation when organization is curtailing its total production itself, or reducing the capacity, or for any case, it's closure of the branch or discontinuation of the business unit, significant downsizing leading to reduced employees covered, and the amendment eliminating the benefit of the future services. So whenever any kind of curtailment happens, then in that case, what we have to do, remeasure the defined benefit obligation immediately, recognize the curtailment gain or loss in the P&L, and adjust the planned asset to the fair market to the fair value at the date of the curtailment. So this is three things that we have to do at the time of the curtailment. While we are talking about settlement, so settlement occur when the entity eliminate all the further legal or the constructive obligation for part of the benefits payable. So buying an annuity from an insurance company to pay the employee pension, lump sum cash payment offered to the employee in exchange of the benefit elimination, and full buyout pension. So basically, it's a one-time settlement, which is like amount which is being paid to the employees. So in that case, whenever these things happen, what we have to do, we have to re-recognize the related portion of the DBO to the extent it is attributable to the settlement. And then what we have to do, de-recognize the related portion of the planned asset as well, because the similar portion will be liquidated to pay off the liabilities for the employees, and then we have to recognize the settlement gain or loss in the P&L. Simple. So we have to settle the amount, and then for that settlement, if any gain or loss is there, we have to carry that amount to our P&L, charge that amount to our P&L. We'll move to the next slide then. Okay, so on presentation, so we already have spoken it, and we have shown it as well. So our service cost, past service cost, net interest cost will be shown as charge to my P&L depending upon if it is net increase. If it net increase, it will be credit to my P&L. Any remeasurement will be measurement through my OCI, and in the balance sheet we have to show it as a net benefit, which is a net benefit liability or asset presented in a single line, which needs to be split. This is the current or non-current as the case may be. And then what we have to disclose, we have to disclose the characteristic of the plan for each funding, amount of the financial statement, that is the DBO, fair value of the net assets, maturity policy of the obligate profile, which means that within how many years this present value of a planned asset would be matured, or what is the time within which this my defined benefit obligation will be paid off, and then actuarial assumptions, if any. So we have to record all this information in our disclosures. So we'll move to the final slide. Look at some of the differences between IND AS and IAS. Okay, so largely there are no differences. The only one difference which is majorly is on account of the way our discount rate is to be determined, which is based on the government bond in case of the IND AS. However, it is based on the high quality corporate bond in the case of IES. But barring this, all other concepts and the all other fundamentals and the dynamics of the both the IND AS are same, and there is no major change apart from some minor changes here and there to make sure that it is in line with the Schedule 3 of the Companies Act when we are making the presentation. So with this, we come to the last slide. We'll quickly move to the thank you slide then. Okay. So this is the last slide. So I would like to thank all my subscribers and viewers for watching this. It is our continuous endeavor to bring up these kind of presentations so that we can enrich the knowledge of the professionals who want to have more understanding on the NDS. And obviously this can be consumed by the students who are pursuing their courses for the CA, CS or CMA. And during the presentation, it may so happen while explaining some of the examples, there is some slip of the numbers here and there, but that is purely non-intentional. All examples are being created and curated specifically to make sure that the concepts become clear. And if at all you have some thought of wherein you need some more clarity, you can give in the comment section, and I'll get back to you and reply to your comments. So till then, we will come with another IND AS very soon. So till then, thank you. Have a good day and bye bye.